One of my first success cases in Europe was a company called Wayflyer in the lending space. And I was lucky enough to be a seed investor there and then help with Series A, Series B, and then reach a 1.6 billion valuation. And through that, I really learned how lending works. And the beauty of lending is that...
And on Move, recently, someone was openly criticizing, and they're like, the drivers are the ones losing because they make them sign contracts that they don't understand. They find themselves driving and the cost of the loan becomes higher and then they cannot pay it back. And at some point they repossess the car. How do you make sure the companies are not just becoming predatory lenders? To highlight the success of ShopUp, do you have any high-level GMV number or number of merchants?
Well over 1 billion in sales. Okay. I've raised from Sequoia, from Valar, well over 150 to 200 million. So it's a big company. Why we invested there is...
Let's say in an industry, in a model, there's a 100 million revenue pool. If you have two companies competing, it's still worth it. But once there's 6 VC-backed companies going after $100 million opportunity, the pie is being split too thin and then it's not worth it anymore.
Hello Internet and welcome to the 3rd episode of the RareCap podcast. My name is Kyane and I'm a partner at RareCap. Today's guest is Enrique Martinez-Hausmann, who's a principal at Speedinvest. Speedinvest is one of Europe's fastest growing VC firms with over €1 billion in assets under management. They're well known for their early investments in some of Europe's multi-billion dollar companies such as WeFox, GoStudent or Wayflyer. What they're less known for is for successfully passing the emerging market test. They've been investing in Africa, the Middle East, and emerging markets at large for a few years now, and they've been surprisingly successful at it. So what made them properly navigate the complexities of emerging markets while many of the European peers have failed doing so? Let's get into it.
Enrique, thanks for doing this.
Thanks so much for having me, Kyane.
This is going to be fun, man.
Yeah, looking forward to it.
Let's start with Speedinvest and how they've been able to attack emerging markets and Africa in a surprisingly efficient manner. I don't say that just to your face. A lot of foreign investors trying to do stuff in Africa ended up messing things up, putting money in the wrong places, and they say, hey, Africa is not investable or emerging market doesn't work, whatever. They blame it on the market. You guys are one of the very few who've been able to invest in the good ones, and we have a lot of overlap in our portfolios. I have respect for you guys because you come from Europe, you don't have local offices, you don't have local teams, and yet you're in the good deals and a lot of your portfolio companies in emerging markets are working well. So how does the European team do emerging markets in a surprisingly successful manner?
Oh, awesome. Let me first start thanking you. Too kind with your words. I really appreciate it, especially coming from someone like you. But I think the model that Speedinvest has used really makes a lot of sense. We are not locals. Yeah, we try to co-invest with very strong local partners. But our added value, why founders want to work with us, is not because we know the local market. It's because we've invested into very similar business models, doing something very similar somewhere else. And more importantly, we can bring them to the global stage.
I hear that from other foreign VCs. However, what they do is they go to the Y Combinator demo day, they pick some of the African companies there, or they take some of the founders who live proximities to their offices. So if you have a London office and there's an African founder who's in London, then they're going to do the deal because it's someone who knows someone. So it's really through a first circle of networks and through YC, and it's usually not the best deals. Yeah. You guys, I find doing deals that are happening behind closed doors. So tell me the secret sauce.
Maybe first of all, we try to have friends in many places, and we're not someone that doesn't want to co-invest with other people. We like to co-invest with local people that understand the market. We also invest in some of these markets. We actually invested into RareCap, very good returns, by the way. And that enables us to get access to good deals, or kind of like the gossip of who is founding something and who is really exceptional. Second thing is if you are lucky enough to invest into 1 or 2 early winners in a market, amazing founders in that market will want to work with you. Yeah. This is a very weird flywheel effect, by which actually Sequoia or all these guys really profited from it because they were at the very beginning of the tech revolution in the 80s, 90s, and they were lucky enough or also smart enough to invest in some of these early winners, and now everyone wants to get money from them. Yeah. If you're able to do the same in a new ecosystem, such as for instance the African ecosystem, then this will attract amazing founders.
So in this case, I would guess it's your investment in Move, where it became the flagship investment, and everyone's, oh, who did Move? Oh, it's Speedinvest, so let's talk to them. And then now you have access to all those deals.
Exactly. It can be companies like Move, it can be companies like Fair Money. It can be actually some of the comparables in Europe. The fact that we're investing in Wayflyer, that has attracted some revenue-based financing companies. The fact that we're investing in WeFox, the largest insurtech in Europe, has made a lot of insurtechs from all other parts of the world wants to work with us.
And I think there's one element in how I see you guys do things that maybe most Westerners don't do is the actual hard work of adapting to how locals do it. Meaning you are always on WhatsApp. Alvaro is too. You're living the WhatsApp life the African way. Plus you're always traveling around. You're always on the ground. And there's some kind of dedication where you're not opportunistically doing a few deals just because it sounds good, but you have a long-term commitment to these markets. And I think by getting to know you and Alvaro and other people in the team, there's a real passion into doing emerging markets. I think it's different from the other European VCs that I interacted with in the past.
You have to be on WhatsApp all the time. You have to be traveling to these places. I've been 2 months on the road. I've been 3 days in London. My girlfriend absolutely hates it, but ultimately that's the way to get to the best deals. Otherwise, you're only going to end up with the YC companies that are completely overpriced and where most of the times they did not do proper diligence with regards to the local nuances.
Just to give a brief overview on the portfolio and the scale that some of these reach, Move, any kind of numbers you can share. It was public, so you can say Mubadala led the previous round. It was at a 550 million valuation. That's public information.
Yeah, Abi is also a meaningful size.
Actually, he shared the numbers on the podcast, so I can say them. It's not confidential.
Go ahead.
7 million revenue rate.
Probably a bit more by now.
Profitable, 2.5 million EBITDA. So that's also an amazing one. Fair Money is massive. Anything we could share about scale?
Fair Money has well over 2 million customers on the bank side. They have many more on the lending side. I'm not aware that he has shared any public numbers. So it's definitely one of the largest consumer lenders in Nigeria, if not the largest.
Yeah.
So also a very good one. Shara is a good one. Khazna is a good one.
Khazna is massive, great business.
Yes. So yeah, we have been very lucky and we feel very blessed. And ultimately, if I have to summarize the stars and also the ones that are not yet stars, is the founders. You need to go under the skin and really understand what is driving them. And it's not always money. Obviously, money is a big component to it. But these guys, all of them have a chip on their shoulder. They want to prove something to whoever that is, classmates, family members, whatever that might be. These guys want to create the largest technology company in their country to prove someone, I fucking did it. And they all have it in common.
Cool. Before we dig into some of these verticals, and I'm curious to know your read on some of these models. In your deal-making process, were there some of your European reflexes that you had to let go and you're doing a deal and then you're like, I'm using my European lenses. I have to abstract myself from that and I have to think like an emerging market investor. Is there some kind of reflexes that sometimes you have to actually unlearn?
It's an interesting question. If I think about market sizes, in Europe, if you're investing in fintech, almost every market size is humongous. In emerging markets, the market is relatively small. So when it comes to market sizing, it's something we really had to relearn. And maybe I can give you an example here. So when we're looking into earned wage access, so accessing your salary every day of the month, if today is the 10th of December, you can get access to 1/3 of your salary today if you want. We were seeing a lot of companies popping up. So if we look at it, what we did is we went to the WageStream founder, we spoke to them and said, okay, what's the reason people use you? And they said, it's mainly to repair something at home or something related with health or with schooling systems, no? Something pay the bills for school. No? And then after that, we said, okay, what is your customer base? The customer base are companies with 10,000 employees, 5,000 employees, so big companies. So what we said is, okay, let's look into those markets that have a lot of employers that have a lot of employees. So for instance, in Sub-Saharan Africa, most people don't have like a formal job, so to say.
It's micro entrepreneurs. Everyone is hustling.
Exactly. So earned wage access in these markets, the market size is tiny if you think about it. No. So going back to your initial question, we had to rethink that. So what are countries in emerging markets that have employers with a lot of employees? Countries like Egypt, huge amount of employees. Countries like Pakistan, Mexico, all these markets are really good markets. And on top of that, what did we do? We said, okay, how many of those have a mandatory car insurance? How many of those have a schooling system that works? In emerging markets, most of the times it doesn't work. So these markets are really attractive for it. So we spoke to an expert, we tried to make a thesis, and then we looked for amazing founders.
Okay,
Yeah.
that totally makes sense. And just now naming your portfolio, I just noticed there's a commonality which lending is always an essential part of it, whether it's Shara, Fair Money is lending first bank, Khazna and Abi early wage access, Move is asset financer. Usually VCs shy away from these lending businesses. It's not sexy enough, it's not VC enough. When it scales, it becomes a loan book multiple, so it's not really a technology company. Why aren't you scared of this type of deals?
So number one, I really like lending. One of my first success cases in Europe was a company called Wayflyer in the lending space. And I was lucky enough to be a seed investor there and then help with Series A, Series B, and then reach a 1.6 billion valuation. And through that, I really learned how lending works. And the beauty of lending is a very old business. It's around 7,000 to 8,000 years old. People understand lending. It doesn't matter where you go. And last but not least is the margins in lending are really good. We're talking about 65 to 70% margins when it comes to lending, and you can turn a company profitable very quickly. And in emerging markets,
It depends on your cost of capital, right? So
yeah, sure.
if you're raising from lendable at 15%, then how much more can you put margins on top of that, unless it's
and then there is
lending.
hedging costs on top, which is also a disaster for sure. But you can turn a company profitable very quickly with lending, because then you just charge more to the customers. It's who suffers the most if a debt provider provides very expensive loans is a customer, because you're going to pass that out to the customer.
Yeah.
I think it's really detrimental if debt providers are very aggressive, but there needs to be a correlation. If the bonds of a country are at 13% with almost no risk, let's look into Kenya, 13, 15%, Lendable or TLG or like all these debt providers, they cannot give you 13% because they also need to make money. Yeah. Otherwise, I would not give it to a startup with high risk. I would give it to a government. So that's the thing. But I really believe that you can turn a company profitable very quickly with lending, especially if you know how to do it. And there is enough demand for it in emerging markets. And ultimately, it's something that I really understand. So I'm sticking to that.
On the impact on society, on one side, there is closing the credit gap and the fact that most everyday Africans don't have access to those official channels for lending. Same with SMEs and employees. But some might say that, hey, the early wage access where you're bullish on, for example, Abi and Khazna, is basically a tax on the poor. Whoever cannot wait until the end of the month to receive their salary, they have to pay another tax to receive the salary in advance. So you're making the life of the poor even harder by just taxing them for that. And on Move, I heard someone openly criticizing, and they're like, the drivers are the ones losing because they make them sign contracts that they don't understand, and then they find themselves driving and the cost of the loan becomes higher, and then they cannot pay it back, and at some point they repossess the car. Do you think it's more positive or negative, and how do you make sure the companies are not just becoming predatory lenders?
Yeah. First, answering the question, I do think it's not very positive, actually, giving people a possibility to live a better life. And what I mean by that is, what's the alternative? A payday lender? There's payday lenders that charge 20% per week, and that's outrageous. So you have to go one step at a time in order to really bring down the price and make sure that people have a credit history, and then you charge them less. Why do people that have no credit history pay more than people that have credit history? It's because the probability that person will not repay you is just higher. Don't hate the player, hate the game. So if you want to make sure that the business model, the P&L of a lending business works, you need to make sure that you're charging more than what you're losing or having to pay to your debt providers. If you're not doing that, you're going to run out of business. Obviously, we want to have a positive impact on the world, but there is no way around it that the economics needs to make sense. And to be honest, I can sleep very well at night thinking that the drivers at Move will be able to repay back the entire car and ultimately will own a car. And then they're going to be much better off than someone that doesn't have a car, that just rents the car. Sure, it's a hard way to get there, but life is not easy. So I think the alignment of interest with someone like Move, with the drivers, is great.
Yeah. Over the past few years, it's been way easier to raise equity than to raise debt.
Yeah.
So you raise your 5-10 million equity, and then you go and knock on doors for debt. From your portfolio, some of these founders has been the best raising cheap debt in innovative ways. For example, Omer from Abi raised Islamic sukuks. You can get local currency debt. Move also has their own ways. How does an entrepreneur who's building a company that has an important lending component go unlock that capital? It seems so hard to do, and even if you do it, it's going to be extremely expensive, which just doesn't help your business.
That is definitely something that I spend a lot of time with, and that's something where we really believe that we can help these companies. So at the beginning, you're right, you need to start with equity. Yeah, you need to give out loans and you need to show good performance. And then after that, you need to graduate to the first loan facility. And then there is two components there. One is the advance rate or the loan to value, and then the other one is the interest rate. So the first one is how much equity do I need to trap for the first loss? Let's say it's an advance rate of 80%. It means that if I raise 10 million, the debt provider is going to put 8 and I will put 2 million from my equity. And then the other one is the interest rate. That's APRs, very straightforward. Our recommendation at the beginning is don't care about interest rate. Even if you lose money with every loan you do, focus on not trapping a lot of equity and being able to show cohorts that make sense. The repayments are good, that the NPLs are as low as possible, and that you create a customer base that's good. Because the best way to see the credit risk assessment of a customer, or the best way to judge a customer, is by the previous months or the previous installments that the customer paid. If you pay me every month, I will know that the probability that you pay me next month is relatively high. So I'll give you a bigger loan. What you also want to do is have the debt providers competing with each other. Don't have only loans from one provider, have it from three. And if one of them is telling you, hey, I do not want to reduce the interest rate I'm charging you, tell them, guess what, I'm going with someone else. Okay. So competition really leads you to excellence by making them compete with each other and ultimately provide a better price to your end customers.
And maybe one last critic of this lending model, and I'm only criticizing because I'm fascinated by it, and I think it's the real problem that needs to be solved. And I want to spend the next 2 years really getting deeper and deploying more in lending infrastructure. But a lot would tell you, hey, those are extremely risky. Even when you see those companies growing fast, the lenders always have covenants, and if one is activated, then it blow out the whole cap table and all the early investors are wiped out. How are you hedging that risk?
Yeah. You're right, it's riskier, but that's why also they have lower multiples. At the end, if you think about a SaaS business that locks a 4-year contract at once, has very high multiples. Why that? Because they know that they're going to have recurring revenue for the next 4 years. Yep. So if you look into a marketplace deal, like an Airbnb, for instance, the multiples are lower, not as high as the SaaS businesses. Why? Because it's a one-off transaction. And then if you go into lending, the multiples are lower. Why are they lower? Because it's riskier, because you can burn your fingers. But it is also, if not the biggest, one of the biggest asset classes within financial services. So you cannot shy away. If you're a fintech investor, you don't invest in lending, you're missing out on the biggest piece of the pie. And it's the piece of the pie that, especially in emerging markets, everyone wants. People don't want a saving products in Nigeria. No, they're struggling to pay their bills. What they need is help in order to pay those bills. And lending is the one that really bridges that, and the one that really can help them eventually pay for school for the kids or pay for the mortgage of their house.
I totally agree. People are asking for lending. That's their main request, and that's the elephant in the room. VCs don't want to touch it, and the founders are in between. They're like, okay, do I build for what the people want, or do I build for what the VCs want?
If you're a founder, don't build for what VCs want.
Easier said than done, because then you start a lending business and try to raise your pre-seed and nobody wants you, and then you just go back to the drawing board.
So raising money from venture capitalists is not for everyone. Most of the businesses should not be raising money from VCs. VCs actually have been funding way too many business models that actually they shouldn't have been funding.
So if I'm building an SME lender, let's say in Eastern Africa, where do I raise money from?
I've invested in many SME lenders, and I believe that there is a VC market for that. But many VCs are going to shy away from it. Okay, not everyone must like you. Yeah. You can go around and still raise money from other VCs or from family offices, from private equity firms. But there's many different ways you can find your bucks to fund a business.
So Rallycap and Speedinvest are together into a few companies. So we're together in Revio, Shara, Abhi, probably more. And I think that's one of the reasons you decided to write us an LP check as well, because I guess you saw that we look eye to eye in many things. How does LP investing into smaller funds help you as a fund manager?
Yeah, we write very few LP tickets. We like you. We think you're thinking about the fintech landscape or VC landscape in Africa the right way. We want to support you with that. If you think about this, you are going to think about us also. We're also going to get something back when some of your portfolio companies are raising around, or whenever you see a company, you're like, hey, maybe Enrique has looked at this in the past and maybe he can help you diligence that. Now we will be top of mind. And especially us not being in the continent, or even though we want to eventually set up some offices outside of Europe.
In Tunis.
Exactly, in Tunis. Then this really enables us to be like a VC on steroids, because we get access to deals that maybe other people cannot get access to.
Cool, that makes sense. So maybe I would love to shed some light on some of the portfolio companies and understand your reasoning behind them. I know most people already know Move, and Khazna is a model that is well known, but maybe Shara, because it's unusual. Why do you think Shara is a good business fundamentally?
So Shara has actually two sides on the business. No? One of them is a SME BNPL solution that's operating in Kenya and Nigeria. And on the other side, they have an infrastructure play. They just acquired a bank in Kenya. They will be able to raise local deposits and offer a B2C and also B2B2C solution to end customers. This was a big founder bet. I said it before, we really try to look for founders that have something to prove. Grant, Jordan, are great entrepreneurs, the founder of Twiga before, and we really believe that he understands the local nuances of the Kenyan market. People in Kenya are more and more, let's say, pissed at how M-Pesa is working. We want a different solution, something that's cheaper, that's more transparent.
It is expensive.
It is expensive. And also, it's not really transparent. The other day, I was trying to look through my M-Pesa account, and there was not really a commonality between the amount that I'm sending and how much I'm being charged. Long story short, we believe that there's going to be a shift in the Kenyan payment landscape. We think Shara can be a good player in that. And for SMEs, they can really create the backbone of their capital needs. And the fact that they just acquired the bank license means that they will be able to raise local deposits, and that will reduce the cost of capital substantially.
And another company you did outside of Africa, ShopUp, I think it's in Bangladesh,
Yes.
right? Yeah. And ShopUp is Maxab, Wasoko, Trade Depot, so the B2B supply chain for FMCG, retailer, distributors, wholesalers. We've seen these models pop up in Africa and elsewhere. And there's this eternal debate about asset light, asset heavy. Nobody knows whether it works or not. But ShopUp seems to be working well, right? Do you have any high level numbers you can share? And also, why do you think the model works where many in Africa weren't able to pull this off?
I do believe ShopUp is a success case in the Bangladeshi ecosystem. Actually, you didn't ask me why we didn't invest into any of these B2B players.
Here we go. But just to highlight the success of ShopUp, do you have any high-level GMV number or number of products?
Well over 1 billion in sales.
GMV, but 1 billion GMV? Okay.
I've raised from Sequoia, from Valar, well over 150, 200 million. So it's a big company. Why we invested there is obviously we think that the B2B marketplace makes tons of sense, especially in emerging markets where there's so many micro entrepreneurs and SMEs. But the same thing applies to Nigeria or any other of these markets. But the thing is, if we look into Nigeria, how many players are trying to do this? Soko, Trade Depot,
Omnibus,
Alerzo
at some point.
Exactly. So there's 4 of these players, and that's actually where VC actually destroys many ecosystem. Is it's a race to the bottom. Like
agree.
People are gonna go always with the cheapest solution. No, I would do the same, but not in Bangladesh. Why not in Bangladesh? Because there's no competition. So we selected a market with ShopUp. We said, okay, there is a need for this, but name me another startup from Bangladesh. Yeah. So there is almost none. It's a big market, highly dense. And not only do they offer the B2B marketplace, but they also are the largest last mile delivery company in the country with more than 50% market share. They're the largest fintech in the country, without any doubt, much bigger than any other company operating there. The fact that there is no competition, because they're bigger than the other ones or because the ecosystem is not as developed, has made them remain relatively stable when it comes to their margins. Yeah. Whereas a Wasoko or a Trade Depot or whatever, they had to go down with the prices in order to keep up with the competition and make sure that the volumes remained high. Because guess what? VCs were telling them, why are you going down? I want you to sell more and let's subsidize losses.
I'm enjoying this conversation because you're confirming a lot of things that Hayden and I tell to our LPs. The low interest rate and that capital flow into Africa messed up with the revenue opportunity, because the revenue opportunity is already relatively small. But let's say in an industry, in a model, there's 100 million revenue pool. If you have 2 companies competing, it's still worth it. But once there's 6 VC-backed companies going after $100 million opportunity, the pie is being split too thin, and then it's not worth it anymore. So yeah, I love that we see eye to eye yet again. And then to wrap up, curious about your own investing journey. Were there any kind of assumptions that you had early on in your investing career that turned out to be wrong?
Yeah, I was always very impressed by brands, and people are always impressed by brands. That's why people have fancy clothes or go to very good universities or whatever that might be. I was a person that if someone had their HBS degree, I was like, this person must be a beast. No? At the beginning of my career, given that we invest in early stages and it's all about the founders at the beginning.
Ex-Google, like ex-Microsoft.
Exactly. All of those brands. Maybe they were the dumbest person in the room. No? Yeah. Do your reference checks really well. It doesn't matter you were in a no-name SME. If you were the absolute best person in that company and you learned tons of stuff. It doesn't matter you were in Google if you were absolutely useless. Use that with a grain of salt, and obviously now I'm gonna get some hate from ex-Googlers or ex-HBS people or whatever, but it's not where you were, it's really how instrumental were you in these places.
Yeah. Okay. Last question, Enrique. You said around 30 investments in emerging market. Where do you think are those like subcategories, subsectors that you think there is still an opportunity? Looking at, for example, Rare Cap's portfolio, We've done the banking as a service, the card issuance API, the reconciliation tool, the treasury management, the open banking APIs, the B2B cross-border, all of that. How can you still look forward for something new?
Don't think that now because you have invested into Flutterwave, that's it with payments. No, you can go much deeper with payments. You go into issuance, you go into acceptance, you go into acquire, you go into PSP, you go into merchant, you go into POS terminals, you go into online point of sale, you go into reconciliation, you go into orchestration. So alone in payments, there is 20 different business models. And then another thing that's very exciting for me at least is we invest into companies. And then the companies outgrow us. It feels a little bit like being a parent, and then the founders, they barely want answer to your WhatsApps or to your messages, only to
It's a good sign.
It is a good sign, but that also frees up your time to invest into new founders. Financial services is just so big that I don't think I'm gonna run out of ideas or run out of business models to invest in.
That's awesome. Looking forward to closely collaborating, and thank you for sharing your thoughts and nuggets so openly. And thank you for your friendship, man.
Oh, thanks to you, man. Thanks for having me. Looking forward to many more years of this.
Awesome. Cheers.
Have a good one.
Bye.